Money FM 89.3. Best of breakfast. Bigger picture only on Money FM 89.3.
Good morning. Welcome to the Bigger Picture. Me, Ryan Huang. For the good part of the past decade, a handful of high-flying technology companies have pushed the U.S. stock market to record highs and have become cornerstones of investment portfolios. But that has collapsed this year. Despite the S&P 500 index clawing back into the green for 2025 after being whipsawed by tariffs, tech giants like Apple, Alphabet, Amazon, and Tesla are still down. The Bloomberg Magnificent 7 Index, which includes those companies, as well as Meta, Microsoft, and Nvidia, is underperforming the S&P 500. And that's a far cry from last year when tech and telecom stocks both rose more than 35% to lead the S&P 500's 23% gain. Well, is tech still a good play in this current tariff environment? Let's check in now with Phan Vee Leung. He is the CIO for Trackrecord Asia. Morning, V. How are you doing today?
Hey, morning, Ryan. I'm good. Let's talk about markets.
Indeed, and of course, we've got a lot to talk about when it comes to where things are right now. How do you feel about the technology space with all that's going on right now?
I think it's still pretty much buy on dips. We've had volatility because of trade tariffs as well as sanctions against China in the importing of technology and chips, but it doesn't change the narrative that artificial intelligence is going to change the way that we live, the way that we educate ourselves, the way that we also play. So productivity gains are just beginning to be seen and is going to accelerate as time passes. That will change a lot of things, and I think those who are most prepared and poised to benefit from that would be the big tech giants.
Yeah, that's a very interesting thought to have, because in view of what's also playing out, we've got Michael Burry. He is, of course, famous for his portrayal in The Big Short and predicting the 2008 housing market crash. And he has gone bearish on the likes of Nvidia. He's got put options against those shares, which signals a negative outlook on the chip maker. What do you take away from that? Is it maybe overbought in some areas of the AI space?
To be fair, of course, Michael Burry made a lot of money as portrayed in the movie Big Short, as you said. But he's also predicted 20 of the last 2 financial crises, right? So he's always been bearish. He's not always correct. It could turn out that this is the next sign that he's correct, but I don't think so. What he's done is, of course, he's sold all his portfolio stocks except for Estee Lauder, and he's gone bearish on Nvidia and some tech stocks as well. But I think it's not going to turn out that way. Of course, we could see a correction in Nvidia, which we did, but he's bounced back quite quickly. And recently, just last week, President Trump was in Middle East and announced some initiatives with Saudi Arabia for them to start their AI center, I believe UAE as well. I think that's going to benefit Nvidia very much financially in longer term. So I'm not quite in the camp with Mr. Burry, but of course he's much more famous and much more successful than I am, so it could turn out that he's right. But as I said, he's predicted the 20 of the last 2 financial crises and market crashes. So he's made his money being bearish. So he's always going to try to be bearish again, right?
Yeah.
That tends to happen when traders achieve their success either one way or another. They tend to stay in that camp for the rest of their careers as well.
Yeah, talking about bearish, he's also bearish on China in the form of bearish puts against several firms, including Alibaba, Baidu, and JD.com, some of which he has had long positions for quite some time. So is this something that resonates with you in terms of his view on China?
I think the bearish China view is pretty much overdone by now, because we've seen, yes, China has underperformed for the last several years. It's been very bearish for some time. The government has not been able to convince the market that it is ready to boost the economy as well as boost the markets. But we are seeing more resolve from them since late last year, and they have been doing what's been supportive of markets, and I do see there are strong signs that they will continue to implement policies to support the markets, especially if we see the economy slow down from here. And they've had it out for their tech sector for the last few years, but this has recently stopped as well, and they've been quite supportive of the tech markets going forward as well for their own technology companies. So I think China also is buy on dips from here out.
All right, talking about buying on dips, we are seeing some pressure on U.S. markets in the form of the concerns around reports that at least Moody's, is the latest to cut the credit rating on the U.S. government from AAA to AA1, citing an increase in government debt and a higher interest burden. What should investors take away from this? Is this a significant development in terms of how this could weigh on markets?
So to put it into context, there's three major ratings agencies that matter, right? So we have S&P, Moody's, and Fitch. S&P was the first to downgrade the U.S. from their AAA rating in 2011. And that caused a big panic. They did the downgrade same way they did on a Friday after the market closed. So on Monday when markets opened, the S&P fell 8%, more than 8% intraday, but closed down nearly 7%, just rebounded slightly. And that was close to the lows for the cycle. It just went lower by less than 1% after that in the days after. It took 5 months to recover from the lows. It was a big panic because it was the first agency to downgrade the U.S. and it is something that was unthinkable in those days. I remember going into the office on a Monday morning at 3 a.m. to watch the open of the FX markets to see what is there to be done, right? And there was a big intraday volatility. Things were selling off. There was a bit of panic. But since then, many investment firms and also exchanges have updated their collateral and investment mandates where U.S. Treasury is in a class of its own. It's not vaguely classified as AAA rated debt instruments. So the effect of that downgrade is much less. And in 2023, Fitch downgraded the U.S. and the move on that day was S&P was just down slightly more than 2%. The intraday lows was slightly more than 2% and closed down 1.4% on the day. So as you can see, it was a big difference in volatility. It's not so much of a panic now because there's no mandate change required. There's no forced selling. There's no fears of what would happen to the financial system because suddenly the AAA rated, the unbreakable U.S. bond is now in question. So now it's 2025. Moody's is pretty much catching to the rest of the ratings agency. And I think the impact would be much less. Since stock futures opening in Asia, we are seeing just about 1% down in the stock futures, not so much of a panic scene. And I believe that's likely to continue as the day progresses. I think, in fact, likely to even bounce as U.S. comes because we've seen this movie played out a few times. The dip is supposed to be bought as well. So I don't think there's going to be any panic. All the mandates that used to just say AAA rated debt instruments have now all been updated to a range and also either to put U.S. Treasuries in a class of its own without saying the rating because the U.S. dollar still is the reserve currency of the world. And even in Moody's rating, it does say that the U.S. economy is strong. Of course, it's just the fiscal position and the debt position seems untenable. What's likely to happen is we are likely to see the U.S. government, especially President Trump, getting a bit angry with Moody's and possibly have some retaliation against Moody's in the form of contracts being pulled on state governments and as well as federal government contracts as well. So I don't think it's much of a big deal. Of course, it's not great, not great news. It's not something that's going to be positive markets, but it's unlikely to be so negative markets because we've seen this played out a few times. And basically, the third time, the little boy cried wolf, right? So not much of a market impact to be expected.
Yeah, to your point, Trump might be a bit moody today. So not the first time that you pointed out. So not a big surprise. Folks have probably seen this coming for quite some time because Moody's, again, is the last one to make it official. So that's the latest we are tracking in the markets, and help us to navigate what to keep an eye out for has been Phan Vee Leung. He is the CIO for Trackrecord Asia. V, thank you for your time and insights this morning.
Yeah, thank you.
All right, catch up with you again soon. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.